So, hi guys, this is Archna Jagtiani. I call myself Butterfly Queen because I know so many people who are not able to make money using the butterfly options strategy, but those are my niche. So I thought, why not call myself something that I'm good at? So that's Butterfly Queen. So the presentation that I'm planning to do today is risk management using strategy diversification. Okay, so let's go ahead and talk about it. So before I start, disclaimer, trading is risky. Any information provided here is only for educational purposes. On my blog, on my Twitter handle, whatever I post is only for educational purposes. So please be careful as to what you risk because it's your capital. Next, about me. I am a contributor and I run an advanced options Discord channel at Laduk Trading. I also have my personal offerings from ArchnaTrades.com. It's Twitter Trade Alert, subscription, option mentoring, and I write a daily Substack called IndexIncomeSubstack.com. This Substack is basically pre-market analysis of where I think, SPX can go or cannot go. And I come up with an cash flow options trade. So we have, you're talking about only index here. So I'm looking at either we have the ETFs, SPY, IWM, QQQ, and DIA, the four indices. You could trade all these indices every day because you have a zero DTE. Even when we did not have the zero DTE before last year, there are four indices. So you could always have a cash flow trade in any of those indices. So that is what I write in my Substack. Like today, I was like, okay, if, banks are usually in IWM, in the small cap. So if IWM does not take out, 1700, I'm talking about the small cap index. If RTY does not take out 1700, then probably you can sell a put spread because it doesn't take out 40-40 today in the SPX. So you could sell the 40-40, 40-40, 40-40, 40-35 put credit spread. I got $1.30 for it, but it was going down. And I'm out for 50% profit already today. So I also write articles for Bar Chart as a contributor. So these are some of the things that I do. In addition, of course, I trade. That's the reason I have Twitter Trade Alert subscription. So about me, I started learning like everybody does technical analysis, and I was trading only using those technical setups. Then in 2012, that's when I started learning technical analysis. And since I'm from the Chicago area, we had meetups and everything, and I met Dan Sheridan. He was a CBOE market maker. So I did an options mentoring class from him. He taught options in a different way, in the sense that you could see volatility and use all the Greeks and make weekly, monthly income. So his style of option trading was, doesn't matter what the SPX is doing, doesn't matter what the index is doing, buy something at this delta, sell something at this delta, have so many days to expiration. And it was very mechanical. Look at the volatility, look at the delta, look at what the theta is. Okay, this is the ratio. After so many days, if you get 10% profit, take it out. If you are down so much, take it out, adjust. So I was just like, okay, everything was mechanical and everything was looking at the option Greeks. And I saw options not only as a way to make money, but actually do it in a way of having consistent income. But not seeing charts was not something that worked for me, because I had learned looking at charts, looking at, what the Bollinger Band is doing. So I'm like, okay, rather than forgetting what I had learned in the technical charts and what I'm learning from him now, why not combine it and make something of my own? So I still look at the charts and do all my analysis, but then now I look at the volatility and I look at the other stuff that I learned, and I use that to come up with a strategy. And so those are the examples I will be sharing. And because this is more about risk management and discipline, this type of trading is more helpful because you're not risking much. So let's go ahead. What is risk? Risk is defined in financial terms as the chance that an outcome will differ from expected return. So ultimately, when we talk about risk 1 to make 3, you should be willing to risk 1, means you're willing to lose that 1. If you're not willing to lose 1, you should not put that money in, right? So that is what everybody talks about as risk. So what if the risk is even less? How do you make risk even less? First of all, you have to do the correct analysis, but strategy selection actually reduces risk is what I am saying is very important. So let's go ahead. Now, risk tolerance. We defined what is risk. You risk 1 to make 3 or risk 5 to make 15, whatever is your thing. But then what is risk tolerance? Is risk tolerance different for different people? I'll say yes. If I have a $10,000 account and you also have a $10,000 account, I'm willing to risk 500, but you're willing to risk 5,000. And then there is a third person who doesn't, even after risking $100, is not able to sleep in the night. So each person has a different risk tolerance, even though their account size may be same, but their risk tolerance is different. So there is something called as risk, then there's something called as risk tolerance. So because why is it the case? Somebody is able to risk 500, somebody else is able to risk 5,000. Their financial situation may be different. Their investment goals may be different. Their time frame may be different. So it is subjective. For me, that's the reason I define risk as taking a small position size with which I'm able to sleep at night like a baby. I don't have to worry about it. If there is any day when I started, did not know what position sizing is or any of that, right? When you're just starting off, you say, okay, yeah, this setup is really good. Instead of taking 1 contract, why not take 2 contracts? Because I can make more. Everybody does that mistake. I have done it too. So, but then you can make sure that my face would tell everybody whether I've made money or when I've lost money, because the position size was that big that if I made money, it would show up as joy. And if I was losing money, my face would really show because it would be red. It would show up. So for me, risk management is position size. I should be able to sleep well. All those things are there. And I've heard everybody say, never risk more than 1 to 2% of the capital, right, on any one trade. Now, if you have a $10,000 account, 1 to 2% is $100 to $200. With $200, what are you going to be able to trade, right? So you would have to probably think about making it 5% of your account. So then, are you comfortable with that? So first of all, anytime you are into trading, you have to think about what you're willing to lose. Are you willing to lose? If you're not willing to lose, do not risk it. Okay. And then I talk about which options to trade. Okay. Liquid options are very important. What are liquid options? So stocks like Apple, Microsoft, many people trade, right? Stocks like Chipotle, everybody eats Chipotle, but not many people trade Chipotle. The bid-ask spread is somewhere more than $500, sometimes $200. So in an option position, okay, This is volume and open interest of Apple. You can see yesterday around 31,000 for 27,000 contracts, 34,000 contracts. So many people traded, so many contracts traded in Apple. So it's easy to get in, easy to get out. Okay. More than 65 million shares traded with Apple. So trading in Apple, even if you get in and you want to get out, it's easy. In Chipotle or Booking.com, if you try to get in, sometimes it's not easy to get out. So risk management also means having or trading only stocks that are liquid. Many people are trading in and out. Okay. Then let's look at what rules everybody talks about. Risk management is you're taking a high probability setup. You have a certain criteria for entry, certain criteria for exit. You put your OCO order, right? Without an OCO order, there is no trading for me. What is the meaning of OCO order? One cancels other. So you put your stop and you put your target long before the moment you are entering into the trade. So you find a 1:3, 1:5, whatever is your setup, risk reward ratio, whatever you have, and you consistently do that with your OCO orders. That's risk management by playing by the rules. Whatever rules you set up, whatever setups you have. Correct? Then you can increase your risk management by adding duration. Right? Duration is another way to increase risk management, have better risk management. So this is a chart of XBI, right? XBI was almost at 84 yesterday. I'm like, okay, this is almost an inverse head and shoulders or a cup and handle now about to break out. Can it get to 90 to 92, which was the previous high, right? Over here? Yes, you think it can. So the easiest thing that we all learn in options, if you think it's going up, you buy calls, right? But how far out you buy calls? You can buy calls for January 2024. You can buy calls for next week. You can buy calls for tomorrow, right? So having good risk management means adding some duration. Give yourself the gift of time. Buy 1 to 2 months out in time. That's another way of doing good risk management, right? Now I am going to be talking about another way of looking at risk management is looking at the volatility. If you use volatility as a guide to select proper or select appropriate options strategy, then you are using what is options, right? Options, the Black-Scholes model and all these pricing and all the math, you don't need to know, but you are using those things in your favor. If you understand the option Greeks, if you understand volatility, you are using those pricing models in your favor by choosing the right strategy, and that in turn reduces your risk because the options are working for you instead of against you. So I'm just looking at XBI chart that we looked at. So the IV for XBI yesterday was around 11. So that's a very low volatility. You are looking at the breakout setup. So the easiest and the most appropriate strategy would be buying calls with some time, correct? Now, you could do that, but you are seeing that most of the breakouts in this environment are failing because we are having a banking crisis, right? So what do? Buy calls and keep waiting? So let's see what else can be done and how it actually helps reduce risk. So let's explore different ways of trading XBI, which has an IV of 11. I could buy the 85 call for June 16th expiration, which is 43 DTE, means 43 days to expiration, right? You're giving yourself more than a month. You would pay $3.50 debit, and it has a theta of 4.7. So when you're buying calls for a particular duration. That premium that you are paying needs to decay, because once the option expiration happens by June 16th, all the options that are out of the money have to become 0, and all the options that are in the money, they become 100 delta, right? So every day for this 85 calls for June 16, which has a theta of 4.7, you are losing $4.07, $4.70. Okay. If XBI is at that 84 level, it was 84 yesterday, today it's at 84, you've lost $4.70 just because you held on to something, right? So what does that do? Losing that theta while you are just waiting for the trade to work, your account is losing money, which means if you have a stop, right? You can have multiple ways of having a stop. You can have stop on the price, right? If it goes below 80, I'll get out, right? That's stop on the price. Then you can have stop based on time also, right? If it has taken more than 5 days, that means it's probably not going to work, or I do not want any more theta decay of my options, I can get out. So you are losing time, you are losing money because theta is working against you because you've just bought a call, right? So if you get the breakout right away, yes, the most efficient trade is to just buy calls. But what in this choppy market, if you're not going to get the breakout, how and what can be done? So if I look at the option chain, the May options have 35.95 volatility, whereas the June has 34.87 volatility, right? So I could be selling, we decided to buy June 85 calls, right? So I am buying something which has lower volatility. I can sell against that which has higher volatility. So I can sell in May while buying the June. I'm covered. Why am I covered? Because I am buying a later dated option, right? Now the May monthly options have higher ID than June, so I'm selling it. The closer dated options that I'm selling has also theta, right? That theta is also coming out, but because it is closer dated, that theta value or the time value that needs to get decayed from the option premium is higher than the option in June that I have bought. So it becomes a theta positive trade now. What does a theta positive trade do? Instead of me losing money every day and waiting for the trade to work, I am making money to be in the trade now. So if I sell a May 19th 86 call against the 85 call that I'm planning to buy in June, instead of spending $3.50, okay, I am only spending $1.83 now. Okay. So, and the May options has a decay of $7 per day. The June decay is 4.7. So I am losing $4.70 for the June option, but I'm gaining $7 for the May option. Okay. What is this doing? I can wait for the trade to work in my favor. Even if XBI does not move much, right? I am still making, and I can wait for the trade to work. Okay, let's look at next. So instead of putting $3.50, if I'm putting only $1.83, I've put less money in. Now I'm not risking 5%, right? Or $3.50 is almost what you're talking, 3.5% of a $10,000 account. I am back to that small 1 to 2%. of the account, right? 1 to 2% of the account. I'm taking $10,000 as the account, right? So I have reduced my risk. I have come back within that 1 to 2% of the risk that I'm willing to do. If I'm putting less money in, I can lose less. But not only that, I am making money while I'm waiting for the trade to work. So I'm putting less money in. I'm getting paid to wait for that trade. And now I have many more options for this trade. I can use a lot of things to make this trade profitable. Okay. First of all, I talked about theta positive. What if, right? It's at 84, right? Today it's down. XBI is down at 83, right? So if you had taken the trade yesterday, 3.5, just the call, you are losing money because it has gone down. Today the market is down. But I was making money because I just spent less and I have made $7 for the option that I sold and losing only $4, right? That's only from the theta point of view, but the price has fallen. So I'll have a small loss probably, okay? But by May 19th, if XBI cannot get to 86, what has happened now? The 86 call that I sold has expired worthless. I am left with an 85 call for June that I only paid $1.83. I did not pay $3.50 at all. Okay. Now I can actually sell something against it and make it a call debit spread. Right. This trade was configured such that I pay less debit. There is no margin required to do this trade. I'm getting paid to wait to be right in my trade since theta is working for me. And my trade has, right? Now, after the May options is done, I can convert this 85 call to an 85-88 call debit spread by selling an 88 calls for June expiration. Okay. Of course, I'm holding this trade only if XBI is working in my favor, right? If XBI is going down and I have a certain amount of loss, which is my rules, I will get out. But this is if it is working in my favor, but it has not gone above 86. So I do not have May calls to worry about. It's expired worthless. And now I'm working with something that I already have. Okay. So if it goes up, I should be able to sell the 88 calls for at least $1. If I can do that, okay, now I have only a 83-cent call debit spread for a $3 wide call debit spread, right? My call debit spread is now 85-88 call debit spread, and I paid only 83 cents for it. Now I am risking only 83 cents to probably make $2.17. So automatically, now I'm not risking 1 to make 3. My risk reward has gone more than that. So I'm just rounding it up. Okay, so I'm risking 80 to make almost $2.10. So which is almost, how much is that? Right? It is still almost three times. So the risk reward is still there. Okay, but now I'm risking very little. It is not even 1% of my account anymore. I have done these kind of trades multiple times, and I've actually made it free. So I start off with a calendar or a call diagonal. The call that I sold or the put that I sold near dated expires worthless. I have a leftover call, and the trade has moved in my direction, where I'm selling now something over it to make it a free call debit spread. I have done that multiple times. Now I have zero risk. Whatever I have put in, I've already taken it out. So I have a zero in trade. Now, what is the percentage gain? If I make, right, a $3 wide call debit spread, if I make the entire $3 over there, and I put nothing in it, I have infinite gain, right? But forget the amount of gain that you can make. How much can you lose? I'm talking about risk management here, right? If I am wrong, if it doesn't go in my direction now, I am losing only 83, not the $3.50 that I paid initially, not the $1.83 that I had done as a diagonal. It's now only an 83-cent trade. Okay, so risk management by doing a calendar and then converting it to a debit spread or converting it to another trade makes a lot of sense to me. Yes, it requires a little more time, work, but when you're right, this is not, I'm not talking about day trading here. I'm talking about swing trading, which means you've planned it. You are waiting for it for multiple days for something to work out. So that means you are holding. If you are day trading and putting $200, getting out at 250, putting $200 and getting out at 150, that's your day trading, right? That means you are not holding something overnight. If you're holding something overnight, you are blocking that much money from your account, which means you should be okay losing it. I'm not okay losing $500. So I won't take that $500 trade. I will try to make it such that I look at the volatility and come up with an option strategy where I am not putting $500. I am probably putting only $200 or I'm putting only $100. Right now, I have anything can happen with Apple's earnings. So I have a hedge. I have a hedge on QQQ where I have a put butterfly, 315, 312, 309 put butterfly. And I think I paid only 27 cents for it, which means I have a $27 hedge. And I can potentially make $3 there, right? So I am, but the way Microsoft ran up, if Apple runs up, I'm losing only $27. I am not hedging by putting thousands of dollars, right? So that is what I mean. If you know different option strategies, if you know options Greeks, you can work together and make a less risky trade, a more efficient trade for yourself, okay? So when we think about portfolio management, not using calendars and diagonals, they are theta positive, but they also overall reduce the risk of the portfolio. What I mean by that, okay? Suppose you are buying Apple calls. Its current beta is 1.25. What is the meaning of beta, right? If it's something has one beta, that means if SPX moves 1%, then up, then you're expecting your one beta to move 1% up. So it moves one lockstep with SPX. So currently Apple is having a 1.25 beta, which means if SPX moves up 1%, you are thinking most likely Apple will move 1.25% up. So if SPX is moving 1% down, you are expecting that Apple with a beta of 1.25 will move down 1.25, right? So this also means that if you're buying an Apple 50 delta call, then you're not long 50 deltas. You are long 62.5 deltas, right? You're doing 1.25 times. So you are 62.5 delta up or 62.5 deltas long. So if you may think that, oh, I have an Apple long and I have a Microsoft long, I just have two positions long in my portfolio. But currently, Microsoft is having more than 1.1 beta. Apple is having 1.25 beta. So in totality, you are not long only two positions, right? Because they both have a higher beta than the SPX currently. That means if market goes up, you're going up more. But if market goes down, probably you're going down more too, right? So you are looking at the overall deltas, how much long you are. That helps because when you are doing a calendar or you're doing a diagonal, you are selling something against. So you're selling something against your 50 delta call. You're selling something, say you're selling 35 delta. So now you are only long 15 deltas. If you're long 15 deltas, that means you're not fully long. Your portfolio is not going to move a lot in a negatively direction, right? That is what I mean. So being 62.5 long deltas, we talked about all that, but a calendar or a diagonal can make it to only 5 to 10 deltas. So when we hear that some hedge fund is 120% net long or short, it comes from here. Okay, so it's not that they have $10 and they are borrowing. Okay, that also happens, that they're borrowing $10 and making a $20 net short position. I'm not talking about that, but they are, when you talk about 120% net long or short, you're talking about based on the beta, based on how much long they are. So they are long stocks that can move more compared to SPX. That is the reason they are more net long or short. Okay. So but by not only having calls or not having only puts, having calendars and diagonals helps you reduce that delta position. Once you have reduced your delta exposure, your account is not as long or as short. So it's not getting affected entirely with what the market is doing. You can play the trade as it is supposed to be played. You can, right? When we talk about correlations, that when you have 90% down days, 90% up days, so you can actually have your portfolio be a little bit different from what the market is doing. Okay. So by doing directional diagonals, I have reduced my net exposure per contract. I have reduced the risk, right? Because I'm paying less. I am getting paid to wait. And I'm not adding a huge ton of risk to my overall portfolio. So I'm not only looking at one trade, I am looking at that trade in terms of my entire portfolio. So not looking only at the part, I'm looking at the whole, right? No trading can be done just looking at one trade as such. You have to look at the entire whole picture, what your account overall. By doing one trade, how is it going to affect your entire portfolio, right? How much that trade is taking, how much percent from your overall account, how many deltas is it adding to your overall account, which means if you were already, so if I'm talking in this regards to a swing trading, okay? So if you're already having 5 long positions and you get an alert for say one more long trade, you have to think in context. Yes, the trade is good. The alert that you got for going long is good. But now, do you need the 6th long trade? If you do not need the 6th long trade, but the setup is good, okay, what to do? Why just go another call? Make it a call debit spread, right? Because when you do a call debit spread, that's what you're doing. You are buying 50 delta, selling a 45 delta, or selling a 40 delta. You are adding only 10 deltas to your portfolio. Okay, you are not adding a huge amount of long exposure by adding an incremental trade to your portfolio. Okay. Now we were talking about volatility and I talked about calendars and diagonals. Let's think about volatility if it is higher. Okay. So if we look at ALB chart, okay, it has been going down, but RSI was showing bullish divergence. But if you look at the volatility, it's at highs, right? The volatility is high over here. So when volatility is high, what does that mean? When we say volatility is high, it means we are expecting bigger range movements. And when do we expect bigger range movements? When there is some event happening maybe in earnings, some news event is happening, or something like right now we have banks blowing up, right? So volatility rises during when there is some uncertainty, some news going to happen. Because people are fearful or because people are uncertain, then people who have to sell those options, right? People only talk about buying options, but the people who are selling options, they assume a higher risk. So if they are assuming a higher risk, they will charge more. So just think about it. If there's something uncertain, you would, just to sell options, you may ask more. That is the reason volatility rises. So when volatility is high, right, and you are looking at this chart, there is a bullish divergence. It's falling. You may think, okay, we can have a mean reversion, right? It can pop, it can have a counter trend rally or a counter trend bounce. And so I'm looking for a mean reversion trade. So if you think buying calls is where you want to do, that is the strategy, then you are buying expensive options, right? You are having high IV and we have earnings coming up, right? Earnings was yesterday. So if earnings is coming up, first of all, nobody knows what happens in earnings. So that is the reason IV is jacked up, right? So taking pre-earnings trade like that to buying calls because you think there is going to be a mean reversion is not proper risk management, is not probably in any, normal technical analysis either, correct? So what to do in this regard if you think that you want to take a trade? So I looked at it, okay? When volatility is, right, we already did that. So when I'm thinking about this trade, earnings was there, so no trade. Today in the morning, the IV had not yet collapsed, right? The event passed, earnings passed. So now there is no fear, right? Whatever it had to do, it did. So the IV starts collapsing, which means the premiums start coming in. So early in the morning, I bought this, okay? Instead of buying a call for a mean reversion trade, instead of buying a call debit spread, I can think about selling a put. Okay, what does selling a put do? When you're selling a put, you are saying that you're willing to be long a particular stock at that particular price, right? When I sell puts, I am assuming the obligation of buying the stock at that particular price. So currently over here, it was 172. I was looking at the 155 put. I'm like, fine. If it has been falling, if it comes to 155, I'm willing to buy the stock there. So I can sell the put there. If I'm selling the put, what happens? Okay. Okay. So you can sell the put, take advantage of the high IV that I had in the morning, which had not yet got collapsed. I can sell the 155 put for June 16th expiration for $6 credit. And I had to put margin up, which was $1,740. Okay. Now 155 put, I got $6 credit. That means if I get put the stock, I'm willing to buy the 155. At 155, I'm willing to buy ALB. But I got $6 credit for it, which means if I get put the stock, my cost basis is only 149, not 155, because I got $6 credit for it. Okay. Now the brokerage is going to keep some margin because you have promised that you're going to buy it at 155, right? So that is the reason you have some margin they will hold. Now, today in the morning, I sold it for $6 and currently it's worth only $3.70. So I already made $2.30 profit. It's not moved much. It was at 172, even with earnings, which had a higher expected value. It is only at 179, right? So it moved around $7. And it's a June expiration, which means I'm talking about a 43-day DTE. I still have 43 days worth of theta to collect on this premium. It moved a little bit in my direction, but it was mainly the IV. It was mainly the volatility that collapsed. The stock did not move much, but the volatility came back down. Okay. So now let's see if you thought that, yes, it is good to buy before earnings when the volatility is high, right? You think it can go, right? June 16th, 175 call, you were buying it for, right? I did not show that. You could buy it for $13. One contract, $13 means you're spending $1,300. Now you think about it, you are risking $1,300 is more than 10% of your $10,000 account, which I do not suggest as doing because that's not proper risk management. Okay. So over here, what happens? Now the 175 call is only $14.70. So you made money, but you made $170. But selling a put, I made $230. How is it that I sold something? I sold premium 43 days out. It moved in the direction and I still made more money. The calls did not make that much money. The calls did not make that much money because the IV was high. You are buying an expensive option. Buying an expensive option, even if you get the move in your direction, there are chances that you would probably lose or make very little, right? So selling high IV, selling a put credit spread, selling strangles, those are all strategies when IV is high to be doing. Okay, at that time, buying calls or buying puts may not be the right strategy because when IV comes in, you are losing, the IV gets sucked out, you're buying expensive options when IV is high. Okay. So now strategy selection is always helpful. Here is an example of when strategy selection on thinking about this did not serve me well. Okay. I was bearish in Crocs and I chose to do a May-June 115 put calendar. Crocs moved too quickly lower, right? Crocs is currently below 115. So instead of making $475 per contract, I have made only $50 on it. Okay. So if I had bought in, instead of buying, right, instead of doing a May-June put calendar, if I had just bought 115 put for June, because Crocs moved quickly to the price target of 115, it's at 112 currently. Okay. My $3.40 put, right, 115, $3.40 put, okay, would have made $475 more. So it's around $7.70 currently. Okay. So I could have doubled my money here. I chose to do a calendar. The IV was low, market was going up. So I did this. So I was like, okay, it may take some time to come down, but it moved pretty quickly. The breakdown happened very quickly. So instead of making $475 per contract, I've just made $50 per contract. But I had not paid $3.40. I had paid only $1.25, right? If you had paid $3.40, yes, you could have made double. So when there is a breakout or a breakdown that happens right away, then calendars are the wrong strategy to do. Okay. So yes, calendars, diagonals, selling puts, all these doing different strategies helps manage risk, help reduce risk, right? They also are, you are using options for what it is. Options is a derivative product, right? So you are using the options gamma, volatility, theta, and selecting a strategy where those numbers are not working against you, they are working for you. Okay. Now, if you liked this, you can have a coupon code Women20 for any product, and you can get some off. And these are the services that I provide. If anyone has any questions, I'm willing to answer. I can even configure trades for you right now. Just if you want, I still have some time, so we can go through and maybe come up with some trade. Anything, let's look at it. I mean, anything. Let's see, let's come up with an Apple trade for earnings. Volatility is high. Let's look at expected move. Let's see what can be done where you're not risking a lot, right? Let the Apple chart come up. It's still loading. I don't know. Okay, let's look at Apple over here. One day you're expecting, see, it's 97. I mean, I've never seen Apple have 97 IV, but currently 96.88 is the IV. So you're expecting around $7 move. The options is expecting $7 move. So 166 plus 7, you're looking at it going to around 173, right? The August highs. The August high was 176, right? So that is talking about $10 move. If you think Apple reports well and goes higher, and you think, okay, this is all assumption. If you think, I'm not saying that I'm going to do any of this, but if you think that it comes to this 175, 176 and challenges the August highs, what can you do? Okay, if you had to buy just a call, you can buy, if you buy 170 call, you're buying it for 176 right now. 176 is the 170 call. If it goes 7 points up from 176, 7 points up is how much? 173. If it goes to 173, what is this 170 going to be worth? Right? Tomorrow is Friday. If we close at 173, your 170 calls can max be $300, right? $3. And you've paid $1.75 for it. So paying $1.75 and the max you can make is total 3. That means you are making $1.25. That is the max that you can make. Making $1.25 and you're risking $1.75. Is that a good risk reward? No. Buying a call does not make sense here for me. So then let's think, okay, you think it comes here at that 170, but if it goes to 176, right, where you think it challenges the highs, if it goes to 176, then yes, you are looking at it being $6 and you pay only $1.75. So that's a lotto trade, right? You are paying $1.75. If Apple goes to 176, then your 170 call will be worth, because there is tomorrow's expiration, right? They will be worth $6. Then there is good risk reward. But what if Apple does not report correctly? You are losing the whole $1.75. So you have to think, are you willing to gamble $1.75? Because now there's no amount of technical analysis, no amount of account management going to help you. No amount of risk management or any stop is going to help you. Overnight, based on whatever Tim Cook says is going to happen, right, to the stock. So you are not in control. So why take the risk? So I don't trade much of earnings, but if I had to, and you think it is getting to this place, let's see what a call debit spread would do. So if you do a 172, 175 call debit spread, you are spending now 47 cents, right? If it comes, now you're spending only $47 and you can potentially make $2.50 or $2.03 profit, right? So now there is 1:4 risk reward. From $1.75, right? Making at the most $3 or so, right? So from 1:2 risk reward, you are going to 1:4 risk reward. And if it doesn't work, you are not losing $1.75, you're losing only 47 cents. Now you think it comes there and gets pinned probably. So then you're looking at probably doing a butterfly trade. $7 from 166 is still 173, but you think it challenges August highs and comes to 175. Okay, so let's try what you would be spending for a butterfly. So if you had to do a butterfly and you think it comes to, somewhere at 175 gets pinned, 172.50, 175, 177.50, call butterfly can be done for 20 cents. So this is like you are buying one burrito. You've eaten one burrito for this trade, right? Are you willing to risk $20? If you're willing to risk $20, and if Apple pins at 175 tomorrow at expiration, then your $20 can become $2.50 or $250. So from $20, you can make $250. So the risk reward has changed, right? You're risking 1 to make more than 5 now. So you're not only by selecting the proper strategy, right? When volatility is high, what happens when volatility is high? All these options are highly priced. You're buying 1, you're buying 2, selling 2 in a butterfly. You have a debit spread and a credit spread together, right? So you're paying very little for it, but then it has to pin there, right? So if it pins at 175, your butterfly of $20 can become $2.50. Now you may think this is gambling. Before earnings, any trade is a lotto, okay? So now do you want to pay $1.75 buying a call for a lotto trade? Or you want to do a debit spread and spend 47 cents for a lotto trade? Or you want to do a butterfly and spend 20 cents on a lotto trade? What you are risking, that is what is, you're risking $20 here, $47 here, and $1.75 for just buying a call. So where you are risking less is where you're paying less money. That is where I'm risking less, right? So that is the reason I think having the right strategy selection actually reduces risk. My trade alerts are on Twitter. It's Twitter, so it's directly DM'd. So you get notifications. But my Substack, everything is it's in the morning before market opens. The pre-market, what I think, where the market can go. I give ES levels where I see the resistance and support. And based on the volatility, I come up with a cash flow trade. So today's cash flow trade was selling 40, 35 put spread. And I was able to fill it for $1.25. And in between when we ran up, right, over here, over here when we ran up, in this run up itself, I was able to get out for 70 cents profit or something. And I got, because the moment I put it for 50% profit, I was out. So for today's cash flow was done in the morning in 30 minutes. So that is what I do it in Substack. But yeah, butterflies, I have a butterfly trade for Apple as my hedge. If anything happens, if Apple does not report correctly, anything, then why can't we go down? Already banks are having issues. So that is the reason and QQQ is the only one that has not fallen. Okay, so the way I thought, okay, IWM is already at the lows, almost close to March lows. Microsoft, Apple have been holding up the QQQ. So if Apple does not report well, which is the index that has the highest probability of going lower? QQQ. So my hedge is in QQQ. Apple has the biggest weighting in QQQ. So why would I hedge using SPY or IWM? I won't. I'm using for Apple's trade earnings, I'm hedging using QQQ, not any other index. So those kind of sometimes it pays. I feel that for swing trading, you have to put in a little more thought and come up with a better strategy, because you are making options work for you rather than you're not fighting the option numbers. You're not fighting gamma. You're not fighting any of those things. You're not fighting the volatility. You're not fighting the time decay. They're working for you. And if you can think a little bit differently about how much money you pay and converting them, it really helps. So I think my time is done.